Across to Nilesh Shetty, he's portfolio manager at Quantum Advisors. He's joining us now to take some questions. Nilesh, good to have you with us here. Thank you very much. I mean, Pavitra outlined those numbers. Although, I mean, now it should all normalize, right? And we should see a sharp fall in these categories with what we've already seen. What's your sense? Any perspective on this?
No, that is correct. So when we interacted with the AMCs after the regulation came in, a lot of them suggested that the kind of flows that they expect in the month of March is the flows that they got over the last 3 years, purely because of investors wanting to take advantage of this rule. You will see a sharp drop off from April onwards. So some investors who had money or cash flows that they were expecting, even say April or May, borrowed and invested right now to ensure they lock in that tax advantage. And they are happy to pay that sort of interest cost for the month, 1 month or 2 months over that period. But you should expect, again, I'm not sure whether this money will last for 3 years because nobody knows where it will be. But just to have the option value of getting that tax advantage, they would rather invest now and lose that tax advantage. But you should expect a sharp fall later on once April comes over.
I think, Pavitra, we'll get the insurance sector data also, right, shortly.
Yeah.
Those numbers should also be bombastic, right? I mean, should be very, very large. Nilesh, so what's the call now here on from markets? What are you telling your clients?
For us, the style that we follow primarily is value. And surprisingly, a lot of value is coming through in the BFSI space. So we've actually added an asset management company to the portfolio. We've added a general insurance company. A life insurance company is getting very interesting for us. And we, of course, have very large positions in banks, private sector banks at the moment. So irrespective of all the negativity, we are actually quite bullish on the market. You have large pockets of value available if you want to build a portfolio for the next 3-5 years. Near term, there could be challenges in some of these sectors. But if you're a patient investor, the valuation that they're trading at right now are probably sort of the lowest that they've traded in the last 10 years or 15 years. In some cases, because some of the sectors were newly listed, last 5 years, this is the lowest that they've traded at. So you have to bear sort of the next 12 to 18 months where there are specific issues in the sector. But if you're a long-term investor, then it's a great time to build a portfolio, actually.
Nilesh, we were talking about this earlier on the show as well, how so many brokerages are sort of just really sort of saying that this is a good time to accumulate money and build your positions in the market, because we have seen valuations correct quite significantly. You mentioned banks. Do you want to take us through a little bit more in terms of what you're looking at within the banks? Is it the large cap? You did mention private as well, but what would you look at within the banking space where you think, this is perhaps a good time to be putting money to play?
Yeah, for us, it's primarily valuations and the fact that they are trading at the lower end of, say, their 10-year averages or 15-year averages. Most of these quality banks. Again, I'm not sure what is the worry that the market has, given that credit cycle is about to pick up in India. Again, we remain very bullish on the capex cycle and the broad-based economic recovery that is unfolding in India. But for them to trade at valuations, given the quality of franchise that they've built, for us, they offer value right now. So it's just that they're trading at, say, 30-40% discount to their long-term averages. That is why they're attractive to us right
now. No, got that. Now, on you mentioned insurance, right? Did you indicate LIC as one of your top ideas?
No, not LIC. I cannot mention specific names, but we are more interested in the private sector space that in the insurance, life insurance sector. Again, the concern that market has is if the tax advantage goes away, will the sector grow? And it is not that the Indian consumer is different to the rest of the world. The rest of the world did not need tax incentives to buy life insurance. I don't think tax incentive is the reason people go and buy insurance. It's an add-on. So given where penetration is in life insurance, I think there is a structural story underway. It was priced for perfection, say, 4-5 years ago. Since then, valuations have corrected 50% in this sector. So at these levels, they do offer a margin of safety. And so within the private sector space, you can get good quality franchises right now. If you're a patient investor ready to ride out the next 1-2 years of uncertainty, you will make decent money in the sector.
Yeah. Although, I mean, if one looks at the number of growth in the number of policies sold, right, the growth has been actually pretty poor, some 3-4% kind of growth, right, over the last many years. Yeah. But stocks have also corrected quite a bit. Any thoughts on, you like banks, you said, but any specific thoughts on Bajaj Finance versus, say, an HDFC Bank? growth rates have come off quite a bit for Bajaj Finance, actually almost comparable to where HDFC Bank is. I'm talking about, the advances growth, AUM growth, advances growth actually. If you look at the profit growth also, projections are that the growth rates are converging now. Not what it used to be, between say 2012 and 2016-17. Valuations though are still very rich. Any thoughts, Nilesh?
So again, I will not be able to comment on specific names, but like I said, it's a value portfolio. So some of these consumer financing companies will never make it till their valuations correct quite meaningfully. Again, these are great businesses and we would like to own them, but that those valuations, a lot of sort of good news is already priced in. So we added HDFC Bank in the COVID crash once valuations came off quite materially, where we thought now the margin of safety is very high. But some of these consumer financing names have been very, very far away from our levels that we think they look attractive.
Right. Nilesh, have valuations corrected in any of the new age companies enough for you to look at them and feel comfortable now?
So again, we are tracking them actively. Valuations have corrected meaningfully, but we just have to build some level of confidence in the business models of these companies. So we need to get a sense of how they will generate cash flows and how they can retain those cash flows. Right now, still a lot of it is on hope, where they think they will be able to monetize whatever they've built in terms of customer database or sort of the franchise that they've built. But for us, when we model these companies out on cash flows, it's still very difficult to justify the valuations. But it is getting interesting to us. We are tracking it very closely. At some point, we might just add one or two in the portfolio.
I mean, anything, value is size agnostic, right? You can find stuff in mid caps, small caps where there's been a fair bit of damage. Anything you want to highlight, Nilesh?
So we run a very large portfolio, roughly just over $2 billion. So it's not that easy to sort of add small cap, mid cap purely because of the liquidity. Once you go below top 300 names in India, liquidity suddenly dries up. And buying in is okay. If you're buying, you might get quantity as you add these stocks. But when you're trying to exit, it becomes very, very difficult. So we have a liquidity filter because of which mid caps and small caps do not come through for us. But within the mid-cap, small-cap space, there are some quality names which are priced to perfection. So adding them to a value portfolio has never made sense to us. And so
I'm talking about the 101 to 300 in that group.
Yeah. Again, we've not. We at the most, I think we have about 10-15% right now in that mid-cap bucket.
Okay.
But we've not got any major sort of good companies and valuations that we are comfortable at. It's not that. So the good ones everybody knows, and they price it for next 10 years, 15 years in terms of earnings growth. I don't think we'll be able to buy into these companies.
All right, Nilesh. Thanks very much. Good speaking with you. Appreciate you joining in, and thank you for your perspective. Well, I think we'll take another.